Okay, traders, welcome back. This is now part 3 of the higher time frame bias determination, right? So I've had a lot of questions recently about traders going through losses. Now, the first thing I should say is trading will always have losses. Losses are the tuition you pay to become a profitable trader, right? Yes, we don't spend 4 or 5 years spending 60, 70 grand in a college or a university. Our tuition is paid through the losses, right? But I am now going to be teaching you a 4-step process, which you can see on your screen, which will reduce the losses you take. And the way I do this is by introducing mechanical systems to your processes. Now, think about this. There's often a phrase, trade like a robot. Now, we as human beings are not robots, we'll never be robots, but we should try to alter our behavior in trading so that we can become as robotic as possible. Robots are machines. Machines are programmed through systematic instruction. So if we can develop systems and processes and mechanical edges within our trading to then apply in the markets, we'll have a much higher probability of catching those winning trades and increasing our strike rate. And psychology and strike rate work hand in hand. And what do I mean by that? Now, there are some people who have a 25% strike rate and they can make it work. And there are traders out there. Richard Dennis, I think, had a 10 or 20% strike rate. And he made over 200 million. Whereas I feel that a lot of traders who are coming into not just ICT or order flow, but just any concept in general, they need to have a strike rate above 60%. People say 50. I think 60% is good, right? Because you want to be winning more than half of your trades. Now, when you can have a positive win rate, which is something I mean over 50%, when you can have a win rate over 50%, your psychology will naturally take care of itself. Now, psychology itself needs to be improved to a higher strike rate. How do you increase your strike rate now? Well, yes, it's being mechanical using the 4-pillar approach that I'm about to teach you, right? But the 4-pillar approach comes down to determining a higher time frame bias. If there's nothing you take from this video, just understand this. You want to be trading in line with a higher time frame bias. And how you form a higher time frame bias is something that we are now going to go over in this video. And it is the most powerful topic within your trading, right? So I do recommend checking out part 1 and part 2 of the series if you haven't checked that out, because we're going to be going a little bit fast through the basics today. So if you want to get up to speed, please watch those videos in advance. And also I am offering free one-to-one sessions, both for psychology and for strategy, and for psychology and strategy calls combined, if anyone would like to get some free training. But let's put that to one side and let's get into the video. Now, this is GBP JPY, a very, very popular and volatile pair. So we're going to be going over the 4-pillar approach. Structure, DRT, which is dealing range theory, PD arrays, and fair value gaps. Right, so if we look at this naked chart over here on the weekly time frame, I'm going to go a little bit quicker today. Now, for those who don't understand what I'm doing, I again highly recommend checking out the previous videos. But what we have over here is we have a structural high and we have a structural low. So this is our dealing range in the weekly time, right? This is our dealing range in the weekly time frame. So this is our structure high, this is our structure low. This is our dealing range. Now we have premium and discount arrays. Anything above the 50% is a premium. Anything below is a discount. Now, if we dive into some recent price action here, not recent, sorry, this is back in 2008, but if we just go to the premium, what we're looking for is fair value gaps in the premium. So we're looking for this area over here. This is one fair value gap, and this is a point of interest. Now, again, what makes a point of interest? I do recommend watching some of my previous videos on this, but a point of interest in the market is an area that lies in deep premium or deep discount, and also leaves a fair value gap. So these are the two things we look for, and this is what forms our POIs. Some people call it supply zones. Some people call it AOIs, area of interest. Some people may refer to it as an order block, whatever you want to call it, but these are our areas of interest. So now if we kind of zoom these across over to the most recent price action, where do we begin, right? So this is the weekly time frame. This is the very, very high time frames, right? But if we understand what's happened, price has come from a discount. So price has come below this 50% level, and we've been rallying up since kind of just before COVID. The last year has been bullish. We had a bit of a bearish spike, right? But the first thing I want traders to understand is price moves from discount to premium. We're below the 50%. Now we're heading above the 50%. But you may ask, well, where do we target specifically within premium, right? So where we target specifically is fair value gaps. Now, this fair value gap is on GJ. This is at 210.599. So basically 210, 211 area. So for those who trade GJ, I'm very much bullish on the higher time frames, and I do expect price to come up to here, right? That is how simple it is to form a higher time frame bias on the weekly, right? Now let's go down to the daily and understand how we can kind of use this for more intraday trading. But for those who trade GJ on the very high time frames, all you have to do is zoom out and use the 4 pillars of structure: DRT, PD arrays, and FVGs. Now, once you understand your PD arrays, we need to understand we've come from a discount. Price can only go to a premium from a discount, right? 50% below, 50% above. Now that we've kind of retested the discount again, price is in very much bullish order flow over here. I expect price to get up to at least this area. Now, because this is a weekly level, we are well within our rights to get here and see some kind of a bearish reaction. But we don't want to predict that too much in the future, because this could take, I mean, we won't get here until 2025 now. I'll be very shocked if we rally up there before then, but it is possible. But nevertheless, our higher time frame bias on GJ is bullish, and that's simply because we have a premium fair value gap to target, which is above us. Now let's go down to the daily chart. Now, the daily time frame is where we can start analyzing more recent structures. So for those who haven't watched my structure series, my previous videos, again, watch them out. But the way that I mark out structure is simple. We have a structure high, structure low, structure high, structure low, structure high, and structure low. Right, so our most recent structural break was in this region, right? This was our recent structural break. So that's kind of our first step. Market structure, step number 1. Step number 2 is the dealing range. Now, once you have your market structure, the dealing range comes right after market structure. So it's important to get your market structure as accurate as you possibly can, which only comes with chart time, experience, and therefore practice. But we have a structural high over here, and we have a structural low down here, right? So this is our structural high, this is our structural low. Now, why do I project the Fibonacci tool the way that I do? Well, these are the fib settings. I mean, it's no secret what numbers there are on the chart. You're only going to need these 3 numbers, and the 50 is the most important because this gives you your premium and discount arrays. Now, let's understand, right? Now we're going to be looking at fair value gaps, both in the premium and the discount. Let's again start with the premium. So yes, our most recent fair value gap is just over here, right? We also had another fair value gap just over here in this region, right? This was also a valid zone over here. But if we just analyze how price has behaved near here, price has violated this. The reason why price has violated this is because we've broken with a body. Price has failed to hold this zone accurately. Price has failed to hold this zone. Price has broken this zone. So we can ignore this zone. But what can we kind of take out of it? Now, when we have a bearish POI, which was this one over here, which I just kind of removed from the screen. When you have a bearish POI and price breaks through it, what that means is that price is, of course, bullish. This is a sign of bullishness because supply or bearish POIs, bearish fair value gaps, have been violated. This is important to understand when it comes to determining a higher time frame bias. Now from here again, very similar to the weekly, we've come from a discount to a premium, right? Notice how price has kind of respected the fair value gaps here and price has respected the fair value gaps over here. We've also had a retracement down, just below the 50% level into a discount. Now, yes, it's important to understand we have a fair value gap over here, right? And we have a fair value gap over here. So the weekly is overall bullish, right? So my overall narrative leans towards price gravitating to this area. Again, why does price gravitate to this area? Why are we interested in this area? Why is it a point of interest? Now, the reason this is a point of interest, very simply put, is because, again, we've left a fair value gap within this region, right? Price has left a fair value gap and it is in the premium. This is what makes it high probability, and this is why we're going to be targeting it. So our overall narrative on the daily time frame is also bullish. And the reason it is bullish is because, again, we have a fair value gap. So on GJ, for those who trade GJ, I expect price to get up to 202. So I expect price to exceed 200 for those who trade this particular market. I expect price to get up to this area. Now, there is a slight possibility. Yes, we could, retrace lower and come higher. And the reason I say that is because we have a massive pool of liquidity over here. This is a liquidity pool. Yes, it's unlikely, the second scenario of price coming all the way down to a discount, but it's something we should be mindful of because as traders, we need to understand where the premium and discount arrays are and where the fair value gaps are. And once you can understand that, your job is to simply trade in line with them. And this comes back to the whole idea of psychology and strike rate. Your strike rate will be much, much, much higher if you simply traded in line with a high time frame bias, towards a high time frame PD rate, such as a daily or a 4-hour or even a weekly, depending on which time frames you use for execution. Now, if we go to the 4-hour time frame, so the 4-hour time frame, we do the exact same exercise. It's quite a repetitive exercise. But now we can see we're in between two kind of zones over here, right? Daily zone, this is a daily premium zone, this is a daily discount zone. But when we analyze our recent structure on the 4-hour, it will look something like this, right? Yes, we've had a break over here, depending on how you mark it. And yes, we've had a break over here. And we've had another break over here, right? So we've seen the market shift bearish, right? We've seen the market shift bearish. We've had a bearish shift of market structure just over here. Now, I just want to make people aware that this low was weak because this low didn't take out the old high. The old local 4-hour high was here. This low failed to do so. So now we've had a confirmed shift of our market structure, right? Because if you look to the left, price was making new highs. But now price is broken once and broken again. So we've had a confirmed shift of the market structure, as you can see from this very, very basic kind of head and shoulders market structure. Now, why do I still keep a bullish bias? Now, this is where we go into ICT concepts even further, right? This is where we really begin to dive into ICT concepts. Notice how we have a bunch of liquidity that's forming over here. We've got massive trendline liquidity, as well as our daily fair value gap, and price will gravitate towards daily fair value gaps. Yes, we have a daily fair value gap down here. And yes, we also have a massive pool of sell side liquidity, but we also have a massive pool of buy side liquidity. So you may be asking Price Action Labs, how do I know whether price is going to target here? Or how do you know price is going to target here? Well, I don't know for sure. But this is where market structure becomes very, very valuable, right? So again, let's analyze the most recent dealing range, right? So now that we've gone through dealing range and we've gone through liquidity, let's understand the most recent dealing range we are currently in, right? So we have a structure high over here and we have a structure low down here. And now price is pretty close to the equilibrium, which means that we could see some choppiness. But again, we have a fair value gap up here. We got a very small kind of POI, but we have a fair value gap or an inefficiency over here to fill. This is a fair value gap. So we could see price trade higher before ultimately heading lower, because yes, we do have a daily zone over here. But if you remember from the daily time frame, our overall narrative was to take out this POI, then eventually this weekly POI over here. So the narrative is actually bullish, right? The narrative is actually bullish. Now you need to be careful with this, right? Because when price does get into this premium, you need to be careful that we don't see a reversal, because price is at a bearish fair value. Yet price is in a premium, 4-hour premium. So it's well within its rights to continue. But if we do see price violate this local 4-hour high, this can then be used as a demand or a support to then continue higher. So this is my kind of thesis for GBP JPY. Also, quickly, if we look to the left, right, this kind of area, this kind of bullish push over here hasn't come off any major fair value gaps, right? Over here, the price is pretty efficient. We haven't got too many fair value gaps, right? So this could simply be a sweep of liquidity. We are Tuesday going on to Wednesday, so we could see that low of the week, that weekly due to swing before it move higher. But overall, you can see how we're using all the different concepts of liquidity, of PD arrays, of dealing range, basic market structure to form an overall higher time frame bias. And yes, I'm going to answer the questions. This can be used on any Forex pair, any crypto market, futures, indices, gold, even any country stock market. When you can understand basic structure and pair it with fair value gaps and basic liquidity, there's no reason why you can't sieve out a higher time frame bias in pretty much any market. And if you follow these simple steps, these mechanical processes of structure, dealing range, PD arrays, and fair value gaps, you should see a massive increase in your confidence. You should see a massive increase in your strike rate. And when you have a good strike rate with good confidence, your psychology will naturally improve. So the lesson I want you to take away, other than the technicals, is to start treating trading like a mechanical process. Start treating it in terms of having a system and following the system, and naturally your confidence and strike rate will improve, and then that will then lead to an improvement in your psychology. So don't chase psychology, chase excellence in the process, and a good psychology will follow. On that note, I am offering one-to-one sessions to help people strategize this in their own market, in their own way, in their own style, in their own time frame, in their own market. So for those who are interested, the link will be in the bio. Look forward to hearing from you soon, and take care.